Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So sometimes what you want to do as an stock picker is to be able to put together a portfolio that is well diversified. And when I say diversified, I'm not just talking about by sector, I'm talking about diversified by different countries, okay? And you might want to own some emerging markets, you might want to own some European stocks, American stocks, and then so on. And it's really important to do that, because then that means if the US stock market is not doing well, then that means and European countries are doing really well, then you can actually benefit from that side. So it kind of balances things out. When you invest in an ETFs, okay, majority of these ETFs out there will have some sort of a foreign stocks basically, okay? So if they're US based company, the ETF, then they might have companies from the UK, companies from other countries in China and so on. So that is very well balanced for you. You don't have to do anything. But when you are a stock picker, you just have to look around and actually invest in companies that are outside in the country that you live in, okay? And when you look at these things, you could actually own companies in Canada, for example. There's loads of Canadian companies out there. There's loads of different companies in Mexico, in Colombia, for example, in Brazil, Ireland, United Kingdom, in France, in Switzerland, in Germany, Netherlands. Netherlands actually has quite a few amazing companies out there, and you've got Switzerland and so on, and then Italy, South Africa, then you've got China, the whole China, Japan, India, all the emerging markets, you've got Australia. So you've got to then start looking around the world and see if there's any companies out there that you could potentially add to your portfolio, just to kind of balance things out, just in case anything happens to your home country. So what I'm going to do today is I'm going to give you 10 different stocks that are basically foreign. Like none of them are in America, because normally we talk about all the majority of the companies that I own in my portfolio are based in the US. Obviously, there are quite a few, there's a few that are based in the UK and a couple of other European countries, but majority of my portfolio is actually US, like a big tech or big cap US companies that are very well known. So let's just have a look at these companies, right? So the first thing we're going to look at is the ticker. So the company ticker, the company itself, dividend yield. All of these companies pay dividends, okay? 5-year growth rate. So we're going to look at the dividend growth rate there. We look at payout ratio, the years they have increased this dividend, how safe that dividend is, profit margins. So that will tell us whether the company is making money or not. Free cash flow, whether they can afford to pay that dividends, okay? 5-year growth rate, revenue growth. So we want to see if that revenue is actually growing, how much they've basically grew that revenue in the last 5 years. Same goes for EPS or earnings per share. And then the total returns for the last 10 years. Okay. Then we've got the next 5 years. We're looking at how much is this company going to grow their earnings, for example. Then we will look at the Morningstar valuations. Like I've always said to you, I think this Morningstar company, I have no affiliation, by the way. I pay them every single month. But I think they're very reliable in terms of their valuations. There have been 1 or 2 companies, situations where I disagree with them, but majority of the time I do agree with them. And sometimes I even have, after they've actually given their valuations, I like to give myself at least another 5 to 10% margin of safety, okay? And I've got a video coming out. One of the brothers have actually asked me recently if I can put together like a watch list of that on what I'm watching right now. I'm updating as we speak right now. I was on holiday. I'm back at home right now. So I will be doing that in the next couple of days. So watch out for that one. And again, if you're enjoying this kind of content, please, as always, it genuinely helps the channel. You know, the more likes the videos get, the more the algorithm will recommend it to other people. So I would really appreciate that. And then finally, we look at the fair value. So what price does Morningstar think that we should actually buy this stock at? Okay, again, it's not a financial advice. This is just a kind of bit of entertainment to give you some ideas, and then stocks that you can research and to go away and so on. Right, so the first company we're looking at is company that I own in my portfolio, and that's Unilever. Unilever is based in the UK. I think it is a Dutch company, or was a Dutch company, or started in Netherlands somehow anyway, but is based in the UK right now. They have a dividend yield of 3.84%. They came out their earnings report. Basically, they reported just 2 days ago, and the report was really good. And they actually said they pass in a lot of their expenses, okay, to the customers, so they can increase their products, the prices for their products. And this is one of the things I love about this type of company, because they might increase, let's say 10p every single product that they have, but that is they passing on to the customer almost 70% of the increase, the things that they're facing right now because of the recession, because of whatever is going on out there. Okay, because the prices are going up every single day because of inflation, not recession. Okay, because of inflation, they actually have a pricing power, which is really good for me. Okay, then last 5 years they grew this dividend about 6%, payout ratio about just below 60%, and they don't actually increase every single year. So that's one of the things about these companies. They might increase this year, and the next year they might go back to basically just leave it for a couple of years and then increase it again. So it's not consistent. Safety wise, 75%, which is very good. Profit margin about 10%. We normally look for about 15, but 10 for this type of company, I'm happy with that. Free cash flow right now, $6.4 billion. 5-year growth rate, revenues will grow and about 4%, 5%. This is what you expect on average this company anyway. And then the earnings about 5% as well. Last 10 years, okay, if you own this company, you would have got about 6%. That 6%, obviously, it's not a lot, but for this type of company, that's what you will get. And then next 5 years, they're expecting every single year about 7%. Fairly valued at the moment. The price, this is all based, everything I'm talking about today, by the way, is all based US, okay? Because it's easier to find information on these companies when we talk about the ticker, the US ticker. That's why we're looking at the UL here, okay? And $51 per share, that's what they're expecting. So based on their valuations, they think the price should be about $51 per share. Next company is Novo. This is Danish company. Okay, this company is in the diabetes care products. So they have a lot of diabetes care products, and they have 50% of the market share. So they are one of the leading companies when it comes to diabetes products, and they have 50% market share when it comes to those products. Right now, just their dividends are just below 1%. 5-year growth rate about 6%, payout ratio about 50%, and last 25 years they have been increasing that dividend. Safety 99%, that means they absolutely safe. Profit margin 33%, and they have a free cash flow almost to $60 billion, and 5-year growth, revenue growth is about 5% right now, and earnings about 7%. Total return in the last 10 years about 15%, which is really good. Pharmaceutical companies, you expect that anyway, because they obviously the innovative companies, though they innovate all the time, so that's normal. Next 5 years they expect about 2%, which is a little bit disappointing. So, but yeah, just 2% in the next 5 years, maybe because of the drugs they have right now, maybe they're losing their patent. I don't know what the situation is, so that's why you would obviously do a little bit more research if you're interested in this company. Fairly valued at the moment, $110 per share. The next company we're looking at is a Swiss company. This is Roche, and this company is very well known for the oncology therapies products. They obviously, like I said, is based in Switzerland. Right now, they have 1.87 dividend yield, 5-year growth rate of just 3%, payout 47. 30 years or increasing that dividend, 99% dividend safety, profit margin just 21%, which is really good. Free cash flow $17.7 billion, and 5-year revenue growth is about 4.5%. 5-year growth in terms of the EPS is about 7.8, which is quite nice. Total return in the last 10 years, you're looking at about 9%, and the next 5 years they're expecting at least a 7% growth. And it right now is 23% discounted according to Morningstar, and their price target is 55. There are loads of different tickers for this company, but this is the one I went with. Okay, so ADR common stocks, that's the one I went with. Because there's loads of different tickers, but the Morningstar one that I used is this one here. So there's different tickers. There might be different prices for different ones as well. The European based one, I couldn't find. The Swiss based one, I couldn't find a lot of the information that was after, so I just went with the US based. Basically, they are the same company, it's just trading different stock markets. So CNI is another Canadian National Railway, and 1.81% dividend yield, 5-year growth rate 10%, payout ratio 41%, and they have increased it now this 25 years. So they're now a dividend aristocrat. If they were based in the US, Okay, safety 97%, profit margin 33%, free cash flow almost to $4 billion. And then 5-year growth, revenue growth, we're looking about almost 4%. 5-year EPS growth, we're looking about 8%. And the total returns in the last 10 years is about 12%. Now, next 5 years, they're expecting 8.5% growth, which is quite nice. And 16% premium right now. The price should be about $107 per share. So that is the entry point. So if you're looking at this and thinking, what does this actually mean? What this company is saying is, based on their calculations, the price, the intrinsic value of this company, each share should be about $107 per share. Okay, no more than that. The next one is another Canadian Pacific Railway company. Okay, I think this is the company that acquired another company, another US-based railway company. So yeah, just have a look at it if you're interested. I think they acquired, I can't remember the name of the other company, but they've acquired another business recently. Almost 1% dividend yield, 5-year growth rate about 15%, which is quite nice. Payout ratio 22%, very low. And then they have increased this dividend for 19 years in a row. And the safety 76%, profit margin almost 30%, free cash flow $2.28 billion, and 5-year revenue growth is about 5%. 5-year EPS growth about 14%. On total return in the last 10 years, we're looking at about 17%. That's excellent return for a company like this. Okay, and then when you look at the next 5 years, they're expecting almost over 9%, which is really nice. And that's probably why this company is now trading a premium of 21% premium, $64 per share. That's where the price should be right now. I think it's about 100 something or 100 right now, if I remember correctly, or just below 100, I think it was recently. The next company we're looking at is this company, ASML. This is a company that I've spoken about before, is in the semiconductor equipment side of things. Almost 1% dividend yield, 36% of in terms of growth, and growing that dividend in the last 5 years. That's absolutely huge. I think the only company that's better than this is Broadcom, and another semiconductor company that I own in my portfolio. Payout ratio 35%. In terms of the dividend increases, the 13 years of increasing that dividend. Safety 82%, profit margin almost 30, 29.28%. Free cash flow, we're looking at about $9 billion. 5-year revenue growth 22%, which is very high because you expected this type of company anyway. 5-year EPS growth 33%. This is why some people are actually buying this company right now so much, because of this type of growth. If it continues doing this in the next few years and you buy it right now at a discounted 26%, that is absolutely amazing. And then when you look at the total returns over the last 10 years, 22%, and then growth estimates for the next 5 years, we're expecting almost a 30% every single year. Every single year, the expectation is going to grow their revenue, their earnings about 30% every single year. That's absolutely amazing. And right now it's 26% discounted. The price should be about 760 something. Right now, I think it's about 560 something. I think right now, about $761 per share. That's what they're expecting. So great company. Look into it if you're interested. Just go onto their website, learn about everything you're supposed to learn about the company. Then look at their financials. All right, the next company we're looking at is TSM. So this company I used to own in my portfolio. I don't own it anymore. Again, it's the semiconductors, the big companies, one of the biggest companies out there when it comes to the semis. The reason I sold it was because I couldn't actually own this company in my ISA account. It was on the Freetrade account. So I sold it and basically took my money. And since then, actually, it went down quite a bit. It's really undervalued at the moment, as you can see here, 47%. Okay, in terms of dividends, 1.64%. And one of the other reasons actually I sold it was because of the situation between Taiwan and China. Anything can happen, especially right now in the last few weeks. Okay, it hasn't been easy, so people are actually a little bit worried they might get attacked or something. And if that happens, I'm sure these stocks will tank. So that's one of the reasons I didn't want to own. In terms of the last 5 years, they grew this dividend of 9%, payout ratio 38%. They don't increase this dividend as much, so sometimes they just cut it. Sometimes I don't think they cut it, but I don't think they increase it either. Safety 62%, profit margin 40%, free cash flow $13 billion. That is actually in dollars, in US dollars, by the way. 5-year revenue growth 10%, almost 11%. 5-year EPS growth is 12%. Total returns is about 22%, and the next 5 years they're expecting about 23% growth every single year. And like I said already, 47% discounted at the moment. $166 per share is what they're expecting the price to be. The next company is AstraZeneca. I'm sure you know this company is based in the UK. $2% dividend yield. They don't grow that dividend as much. Payout ratio about 52%. They have increased this dividend for 22%. Safety 70%. Profit margin is not great. So profit margin right now is minus 2.56%. So that is not good. I mean, that is generally, that's not really good at all. Free cash flow, we're looking at about $5 billion. 5-year revenue growth, we're looking at about 10%. 5-year EPS growth, we're looking at about minus 50%, which is really weird. So when I was looking at their financials, it's all over the place. Okay, some years is up, some years is down. It's lost the money, it's not making profit, it's making profit. So it's genuinely very messy when I looked at it. But total return in the last 10 years about 13%, which is all right for a pharmaceutical company. Okay, growth estimates is about next 5 years about expecting 15%. So I think they may be cleaning up their balance sheet, and the next 5 years we're expecting about 15% growth. So maybe that's why it's only fair valued. It's not actually discounted at the moment, because people expected this type of growth to come. Because some companies go through a rough period of time, and especially for companies like in the tech companies, in the pharmaceutical companies and so on, because obviously they might come up new drugs, it might not go well, and then they might have some regulations, some sort of a legal situation going on. A lot of things can happen to this type of companies. But right now, this company is fairly valued. The price should be $68 per share. Again, that's the US based. Okay. The next company is a company that I own in my portfolio. RB is one of the, I think I own about 10 shares right now. $2.679% dividend yield. 5-year growth rate of just 3%. Payout ratio 41%. 10 years. And again, this company is actually in the cleaning products. So they have all sorts of cleaning products. And because of COVID time, it actually went up and then went down quite a bit. And that's when I started buying again. Safety, I couldn't find it. What is it called? Simply Safe Dividend doesn't actually have any information for that one, so I just left out completely. Profit margin at the moment 22%. Okay, free cash flow just $1 billion, and then 5-year revenue growth about 8%, which is quite nice. 5-year EPS about almost 7%. Total return in the last 10 years about 6%, and this is similar to Unilever. So they are very consumer defensive stocks, are very much, basically they return about 10%, probably will be the highest. Okay, and the next 5 years they're expecting to every single year to grow the business to grow about 9%, which is quite nice. Fairly valued at the moment. $16 per share based on the US. Again, I'm just looking at the ADR ones. Okay, the US based version. The final company we're looking at is Waste Connections. This company provides basically it's in the recycling and the solid waste, just basically very similar to waste management. Okay, but they are based in generally North America, and I think it started in the US, but they had a merger in Canada, so they trade both basically. Right now they have 0.68%, so basically they collect garbage and recycle it, and that's it really. 16% dividend, 5-year growth rate, 26% payout ratio, 11 years of basically increasing that dividend, 80% safety right now, profit margin about 10%, free cash flow $938 billion, and then 5-year growth rate and revenue is about almost to 13%, and then 5-year EPS growth we're looking at about 8%, total return about almost to 21%, which is really good when you look at this. And I think Waste Management is also very similar. These companies are growing a lot, and you think, okay, this is a very boring company, right? They just collect garbage and then recycle it. That's all they're doing. but they're growing their revenue about, basically they're giving you a return of about almost to 21% basically in the last 10 years. So if you own the last 10 years, you would have received about 21% every single year. And that's really great, like this type of company. Normally, we always chasing the high flyers. Sometimes you just have to look at elsewhere and find companies like this. And this is the reason why I started this channel, because I was doing a lot of research and I'm finding these companies. I'm like, I want to share this with people, okay? And hopefully you're enjoying this. Hopefully you can actually appreciate and give the videos a like, and if you haven't already, okay? And the next basically 5 years, every single year, they're expecting this to grow about 13%. And Morningstar right now is saying 42% premium. And again, that's probably why, because of this type of growth, because what the expectations in the next 5 years, okay, that's probably why it's very expensive. Everybody knows about that, and obviously a lot of these hedge funds don't know about these things, and they start basically buying this. Right now, the fair value price is $92 per share. There you have it, 10 different companies, all international companies that you probably haven't heard about so far, or maybe you have heard about them. So if I were in your shoes and you were interested in any of these companies, again, this is not financial advice. What I will do is straight away read about their 10Ks, go and find out what they've been doing in the last 5 to 10 years, where they've been, what's the, how they work, how do they make profit. Learn about everything about that company, okay? Do they grow their business organically, or do they just acquire other businesses? And whatever the situation is, learn about everything you need to know about the company before you spend a penny. And that's really important. Like I've always said to you guys as well, it's not about just the high flyers, the Apples and Microsoft that will make you money. This company, if you own any of these companies, you would have made at least 20%, 6%, 13%, 21%, 22%, 17%, 12%. All of these companies, if for 10 years, would have given you actually good return. And that's better than your money sitting in an account, right? Inflation would have eaten your money away. This company is actually giving you money. So that's the kind of investment that you should be researching about. I hope you enjoyed the video. I hope you have a wonderful day. Assalamu Alaikum. Take care.